At the far end, we have Mark Freeman. Mark is Chief Investment Officer of Westwood Holdings Group. Mark is a person I've turned to for the past several years as a great resource in trying to get a sense of trends that are taking place in the market, of what's new in the investment community. In his capacity as CIO at Westwood, Mark is also the lead manager of Westwood's Income Opportunity Fund. Next to Mark is Christine Benz, who's the Director of Personal Finance at Morningstar. Christine is a person who tons of writers and reporters at Money Magazine turn to for all sorts of information, ranging from her thoughts on investment products to portfolio strategies. So she's a great resource. I appreciate her being here. And then closest to me is Luciano Kusano, who is the Chief Investment Strategist at Wisdomtree. And as you're probably more than aware, Wisdomtree is a leading global provider of exchange-traded funds. They run several funds that, off of a dividend theme, including some with the dividend growth theme that we're going to be talking about today. So I appreciate all of you coming out here. I'd like to start off the conversation just by noting that we seem to be at another one of those hand-wringing crossroads in the market, or at least that's what the common discussion seems to be. That, you've probably heard a lot of people bemoaning the fact that we are, in an aging bull market. This bull market celebrated its 6th birthday in March. It's now entering its 7th year. Most bull markets don't get past 4. We're also in a period where we could be seeing the first profit recession in the market since the global financial crisis. Forecasts for second and third quarter S&P 500 earnings growth show an actual decline, a modest decline, but possibly 2 consecutive quarters that are being forecast compared to the same quarters in the prior year. We've not seen 2 consecutive quarters of earnings declines since the financial crisis in 2008 and early 2009. So obviously there's a lot of hand-wringing going on. But the point of what we're going to discuss today, hopefully, is the fact that earnings growth, while important, is just one type of growth that's important, that ought to be important to investors in the long run. We're here to talk about dividend growth as being kind of a forgotten type of growth that needs to be discussed in this type of market. And I want to start with Luciano. When we're talking about companies with dividend-growing stocks, companies that can grow their dividends, what types of companies are we really talking about, and why is this an important strategy for you?
Well, we're not just talking about a few. We're not talking about a niche. We're actually talking about 88% of the S&P 500, which consists of dividend-paying securities. So right now, there's roughly 1,400 companies in the United States that pay regular cash dividends, and they pay out in total about $410 billion in dividends. That's what we would call the American dividend stream. Over long periods of time, that stream has grown at roughly about 5.5% per year if you look at the S&P back to 1957. And that 5.5% average growth over time is one of the things that's driven the U.S. stock market higher over the same period. The whole market over that period probably returned about 10.5% on an annualized basis. So the dividend growth and the dividends are in effect the vegetables. They're the nutrients underneath the stock market that allow it to grow over time. A lot of times people focus on earnings and the PE ratio that the market puts on those earnings, but you could just as easily take a look at the aggregate dividends being paid and what multiple is the market putting on those dividends. And we think that's really one of the key drivers, not just for the last 60 years, but in particular, one of the drivers that's driven the stock market higher over the last 5 years.
And in terms of the historic performance and more to the point, recent performance, how have dividend growers performed relative to other parts of the market?
Well, if you just look at aggregate dividend growth of all the companies that pay dividends in the U.S. and the S&P, the dividends in the S&P 500 have compounded about 13% per year over the last 5 years. So that's a period where the S&P 500 returned 14.5% per year. So the lion's share of the equity return in the U.S. was being driven by aggregate dividend growth. Now, if you ask me to screen within that $410 billion, where is the dividends growing the quickest by sector, you'd probably look at technology. Technology, particularly the newer companies that are initiating dividends, Apple, Cisco, some of the others, are driving the growth in technology. But if you looked at where the fastest growth is occurring, you could also take a look at things like consumer discretionary and industrials. So at any given point in time, different sectors will lead at different periods. But I would say in aggregate, if you look back the last 7 years, you would be struck by how fast technology has grown the overall dividend stream.
Mark, let me turn to you.
Sure.
We're in this period of slowing growth, and we're in a period where yields across the board are as low as we can remember. Is that the type of environment that strengthens the case for dividend growth at all?
The short answer is yes, I think so. And it's really the latter point that you touched on, which is the yield environment. And I think that that's one key point investors need to understand, is that in a rising rate environment, and I will say this, I have no idea when interest rates are going to go up or if they go up from there, but in that environment, that growth component, the ability of that dividend to grow is, you can think of it almost kind of as a shock absorber, if you will, to offset some of the negative impact from higher interest rates. The other part that reflects is that underlying company may be also experiencing growth, and so again, it also adds to the total return component of that. So I think it sets up, both from a low yield environment and then also from a demand from growth standpoint, I think it sets up very well in this environment.
And before we get too far along, Christine, I just want people to understand that when we're talking about dividend growth stocks, we're talking about a different beast than the high yielding stocks that people who are seeking current income tend to gravitate toward, right?
That's exactly right. It's a different strategy than one that is strictly yield focused. And in particular, a dividend growth strategy would tend to exclude utilities. It would tend to exclude some of the stodgy telecom services companies. Those companies typically would not be on the shopping list of a dividend growth investor. Instead, it would tend to be a more evenly balanced portfolio, but arguably one that's skewed more towards some of the healthcare companies. Some of the consumer staples companies would tend to be fairly prominent in a basket of dividend growth companies.
And Mark, let me just quickly turn back to you. In terms of the environment right now from a valuation standpoint, how do the dividend growth kind of components of the market look versus the absolute high dividend yielders?
I think they're much more attractive in there. I would actually argue that if you look at stocks that only offer yield, they're priced very much like bonds. Okay, and we all know currently where bonds are priced in this environment with yields at record low. So and I think you see that, again, in that component of the equity market as well.
And they've also behaved like bonds in a lot of ways recently. When we've seen a few interest rate related tremors, we've seen long bonds go down, but we've also seen utilities and REITs to some extent, and some of the other categories suffer as well.
Yeah, I would just to add that, and really to second that comment, the market on a real-time basis knows who has growth and who doesn't. Okay, and you'll see that again on a real-time basis.
Christine, if we're talking about companies that can not just pay a dividend but reliably grow their dividends over time, that would seem to speak well to their fundamentals. In your mind, when we're talking about dividend growth stocks, is this kind of a back of the envelope way of getting at high quality names in the market?
I think it is. In fact, this morning I was screening on our universe of stocks that we have on Morningstar.com and looking at companies that have had a history of dividend growth. What I saw there was that many of them had very high, what we call financial health grades, which is measuring things like debt on the balance sheet, for example. They tended to show very well from this standpoint of having financial stability and balance sheet strength. So when you look at what has performed during this rally that we've been in, for the most part, it hasn't been these stable growers. These companies did well in 2008, certainly. They did great in 2011. But for the most part, they have underperformed more highly levered companies during this period. But I do think in some sort of market shock, they will earn their keep again. I do think that in a flight to quality, these companies will perform well. And given where overall market valuations are right now, I think it's reasonable to start thinking about which parts of my portfolio would behave better in an equity market shock and which pieces might not do so well. I think the dividend growers would tend to do better.
Now, Mark, in terms of dividend growth as being a proxy for quality in some ways, is dividend growth possibly another way of getting at companies that potentially could be faster earnings growers, even if not today, but down the road? I mean, is there anything, does the fact that a company and the executives at that company, if they're setting forth a reliable set of dividend increases over time, does that speak anything about their confidence in
I
their
think
earnings?
so. Yes. And again, we talk almost on a daily basis with management teams, and one of the things we constantly discuss with them is, well, what is your plan for capital allocation? Are you going to use it for buybacks? Are you going to use it for dividends? Or are you going to use it for M&A? And what you see is that buybacks and M&A tend to be they view as relatively transitory. The dividend's permanent, because the cost of cutting that dividend for most management teams is something is a last resort thing that they want to do. So I think when they make that commitment, it's something that they're sticking to from there. And so that's something that we look for, and again, it also reflects not just their confidence in the company, but also their outlook for earnings, because, and as investors, we do need to differentiate between growing a dividend because it's growing of underlying earnings or because the payout ratio is coming up. Now, some companies will raise the payout ratio from that, but I think those companies that are raising it in line with their earnings growth is a very, very positive sign and reflects the management's view of their own company.
So, Luciano, does this get back to your original point as to why we might be seeing more kind of opportunities for dividend growth in places like technology? I mean, if we were to take a look at the Wisdomtree U.S. Dividend Growth ETF, would we see a preponderance of more traditional fast earnings growing sectors represented in that fund?
Well, let me speak broadly, and then I'll address the index in a second. So just as a reminder, the dividends are paid out of retained earnings. So it's either paid out of the earnings you just generated that quarter, or the retained earnings the company's had over time, or out of borrowing. In a very low interest rate environment, companies can borrow to actually buy back their stock or pay dividends, particularly if they don't want to repatriate the profits they have overseas.
Like Apple.
And that's one of the reasons you're seeing it in technology, because the technology companies have so much cash on their books around the world, they don't necessarily want to bring it back into the United States because of the taxes. So many of them have been issuing some corporate bonds to help facilitate the dividend payments, or they're just paying out the dividends because they have a stash of cash. So I would say that there's definitely a connection between highly profitable companies and dividend growth over time. We have one index, which we call the Wisdomtree Dividend Growth Index, which tries to search and scan the market for basically the 300 top companies, large cap companies that we can find that rank highest in terms of quality and growth expectations. So we'll screen companies that have high return on equity and high return on assets, which is a check to make sure they're not using too much leverage. And then we have a growth expectation screen, which is looking ahead and saying what companies are expected to grow their earnings faster than the market going forward. And if you can combine those two things, high historic profitability and higher earnings expectations, you have a good proxy for which companies may grow dividends faster than the overall market. And if you buy into the proposition that dividend growth over time drives the equity return, that might be an appealing strategy, particularly in an environment where interest rates might be headed higher and there might be more headwinds on earnings growth because the dollar is stronger, we're getting a little bit later in the cycle, and for the energy companies, oil prices are lower. So you're in an environment now where earnings growth in corporate America is slowing, but dividend growth continues to grow at a double-digit pace. Now that can't continue forever, but the double-digit dividend growth is giving you a window into what the corporate executives are thinking now. And the conclusion I draw is that the earnings low we're having is probably temporary, and that the dividend growth is probably the better barometer to keep an eye on at the present moment. And then you'll know 6-9 months from now if earnings growth resumes as you get to more advantageous comparisons when you compare the earnings for next December and next March relative to the fourth quarter and first quarter earnings that are being reported now.
And it's important to note that the Wisdomtree Dividend, U.S. Dividend Growth Fund, the top sectors tend to be traditional growth-oriented sectors, right? These are not traditional values parts of the market. There's technology, what's the next?
Yeah, I mean, if you go to Wisdomtree.com, you can take a look at the underlying index by sector, but the top weights right now are consumer discretionary, roughly 20% of the portfolio, information technology, roughly 20%, and industrials. So there's a little bit of an overweight relative to the S&P 500 with respect to consumer discretionary and industrials. But that's what's coming up in our scoring system right now, is scoring highly.
Mark, you're an active manager. Where are you finding opportunities for good dividend growth at good valuations now?
Yeah, I would just echo Luciano's comments on the tech area. I mean, that is an area where we're seeing very strong growth, and I think also a mentality shift by a lot of management teams in that area to now say, okay, we have enough capital, we will now start paying this out in terms of dividends, and I think that's going to continue from there. But look, I also think there's some other sectors of the market where we're seeing growth. We've mentioned industrials. Financials is another area, albeit it probably have to be a little bit more selective from there. And then, as Steve Forbes just mentioned, healthcare is another area where we continue to see growth, and we expect that to persist going forward.
And are you able to find, especially with healthcare, which has been on such a spectacular run over the last 4 years, are you able to find dividend growers at prices that you're comfortable with?
Well, I'm never comfortable with a price. I'd always like to have it lower or get it at a lower valuation from there. But the short answer is yes. But I will also agree with you. I mean, we have the healthcare sector as a whole has had a very strong run. So we're having to be more selective. But again, I wouldn't say limit that just to healthcare. We're having to really do that on a sector-by-sector basis, given where the overall market is today. But you can still find some, I think, attractive opportunities. Are there any examples you can share of the types of healthcare companies that would fall into your portfolio? Sure. One that we've been focusing on, and I own it in the Income Opportunity Fund, is Becton Dickinson. Okay, now if you look at it today, it's a bit expensive, okay, because it does have a very, very, what I think is attractive, but it has a very sustainable and also visible earning stream in and of itself. Okay, but what Becton Dickinson also offers is that they recently completed the acquisition of CareFusion. Okay, and so just merely on the cost synergy side, the deal was roughly almost 18% immediately accretive to earnings. Okay, so that will also be supported from the dividend growth component. But there's also a revenue synergy. CareFusion does not have or has very de minimis exposure to emerging markets, one of the areas where we are seeing the fastest or highest level of growth in terms of healthcare. And so we think that they'll be able to leverage that. So on a today's basis, at the upper teens from a multiple, and I'll admit that's kind of the high end of where I want to go. But you always have to ask, well, what am I getting for that? And so when we look at that, we think we're getting roughly a mid-teens and sustainable earnings growth rate, and that'll be reflected in that dividend growth rate. Matter of fact, Becton Dickinson over the last 5 years has a dividend growth rate of over 10%. Okay, so as earnings have grown, they are also growing that, and we think that that'll continue. I mean, so we look at things roughly on a 3-year basis, and we have it at roughly a 40% upside from there. Christine, Morningstar runs a variety of different publications, including a newsletter specifically devoted to dividend strategies. Morningstar Dividend Investors. Are there any particular recommendations that Morningstar currently has, whether with regard to individual stocks or even funds? Yeah, I was taking a look, Paul, at some of our highly rated stock picks that have a history of dividend growth, have 4 or 5 star ratings, meaning that our analysts currently think that they're inexpensive, and have what our analysts call a low fair value uncertainty rating. So that means that the analyst feels that he or she can do a pretty good job of predicting the company's future cash flows. And I came up with a short list of companies that fit the bill. These companies also all have what we call wide moats, meaning that we think they have sustainable competitive advantages. So on the list were Baxter, Colgate-Palmolive, ExxonMobil, Magellan Midstream, Nestle, P&G, Spectra Energy, and Walmart. And this is a screen that I periodically run on the site just for sort of high quality
reasonably valued companies. It's a pretty short list today because in aggregate, when we look at our coverage universe, we see the typical company trading about in line with fair value, some a lot higher, a few a little bit lower, not a lot of screaming buys, but this is maybe a short list of companies. In terms of funds, and that's really where I focus a lot of my energies, one fund that I think squares nicely with this thesis of dividend growth is Vanguard's Dividend Growth Fund. It is an actively managed fund that looks at a lot of the things my co-panelists look for, and it focuses on valuation as well as dividend growth. Another thing that I like about it, it is a Vanguard fund, so it's got a nice low expense ratio. That means that more of the income flows through to shareholders, which I think anytime you're looking at any sort of income-focused strategy, you ought to keep that in mind. How much are you paying for this strategy? Because that'll come right out of the yield that you receive.
Now an important question that we should put out there, or point, is that a lot of folks may think about dividend growth but not necessarily know kind of where it belongs in a larger portfolio. It's not an asset class per se that we think of as apart from the traditional ones where we build our portfolio. When you're talking to Morningstar clients and readers with regard to where to fit dividend growth in a larger portfolio, how do you express it?
I talk about asset allocation really being the first decision. So think about where you are in your life stage. Think about where you are in terms of needing to spend money year by year. So start there. I've been working on what we call the bucket strategy for retirement planning, and that really means that you set aside 1 to 2 years worth of living expenses in cash, then maybe another 3 to 8 years worth of living expenses if you are retired in bonds, and then the rest you can have in stocks. So certainly even high quality stocks like dividend growth stocks, I'd keep in the stock component. I would not use them as a substitute for bonds, even though bonds have many things that are quite unattractive about them today. When you look at the volatility profile of even very high quality equities, it's so much higher than would be the case for a high quality bond portfolio. It's quadruple the level of standard deviation. So start with asset allocation and certainly consider any equities as part of the equity piece rather than as a fixed income substitute.
So it's decidedly in the long-term growth
Absolutely.
bucket.
So I would, no matter what stock category I were investing in, I'd have at least a 10-year time horizon in mind for that money.
Luciano, we should note that we've been talking largely in the context of dividend growth and U.S. investments, but dividend growth is a strategy that you think is applicable to a broader array of assets, right?
I do, and we've seen with some Wisdomtree strategies around the world how that's been put into place. Certainly in Europe, in the international developed world, having a dividend growth strategy is a nice alternative to the traditional, cap-weighted beta index. If you're thinking about the developed world and you were buying an index fund, it would likely be based off of the MSCI EAFE index. Well, a dividend growth strategy would try to identify companies that are higher profitability than in aggregate, the stocks in that index, and then potentially the ability to grow dividends quicker. We have one strategy that actually hedges out the foreign currency as well. So when you remove currency from the table and the volatility that comes along with that currency bet, and you tilt towards higher quality, higher profitable companies, you end up with a exposure that works well in a broader portfolio. Going back to the previous question, I would think about dividend growth really as an option if you're thinking in terms of large cap growth strategies. But rather than large cap growth meaning more expensive companies with higher PE ratios, higher valuation ratios, the dividend growth portfolio is actually giving you large cap companies with historically higher profitability and higher return on equity and the potential for faster dividend growth. And to me, that makes a lot of sense, especially in the current environment. One of the things that's happened in the last few weeks is interest rates have started to back up. It's been led by the German 10-year bond starting to go back up in terms of the yield. And that's starting to impact stocks and to some extent a separation by sector in the stock market. So the dividend growth stocks we've seen historically have performed better in environments where interest rates started to rise. Because as interest rates rise, it puts more pressure on companies with more debt, more leverage. And that can impact where the market rotates in terms of where it tilts to sectors. And so if you think going forward that rates are more likely to rise than they are to decline, you'd probably want to be tilting a little bit more towards dividend growth than dividend yield. They're both very important over long periods of time, but there are certain periods where the growers do better than the yielders, and we might be entering one of those periods now.
When you look back over the last, the last decade, when we look at the financial crisis period, when we look at these kind of cataclysmic periods, how does dividend growth hold up in those periods relative to other parts of the market?
I wouldn't overstate it. I mean, they go down a lot, just like the market went down a lot. If you have broad equity exposure and the market goes down 37%, these strategies are going to be going down 30, 35, 40%. There's no long-short component to it. When we're talking about excess return over time, we're talking about the potential maybe to generate 1% or 2% above the S&P 500 over long holding periods, not in any one particular year. So I think that's when people start thinking about, can this be additive to my portfolio? And what we've seen on our index, since it's been live now for about a year and a half, is that it's actually been able to add excess return relative to the underlying index that Christine mentioned, that Vanguard tracks, because this index is trying to figure out who's going to raise dividends going forward, as opposed to who's raised dividends in the past. Some of the companies that raised dividends in the past cut dividends in 08 and 09, principally the financial companies. So the companies who are reinstating their dividends today may not appear on a backward-looking screen. And companies like Apple and Cisco, who are just initiating dividends today, won't appear if you're screening for dividend growth over the last 10 or 20 years. So that's one of the reasons we think we should be thinking about looking forward in terms of who's likely to increase dividends in the future.
At this point, we'd love to kind of open it up to any questions if people have questions. I think there are a couple of mics located in the center of the on both aisles. So if anybody has any questions, please feel free to come to the mics and ask them now. While we're waiting for that, another question that that I would have with regard to dividend growth is kind of when we're talking about tilt, when we're talking about putting this as a component in perhaps a large growth strategy, how much tilting are we talking about? Are we talking about the use of a dividend growth fund or dividend growth stock strategy to supplement an existing large cap growth kind of strategy, or is this something that could replace your large cap growth funds?
I think if you had a large cap growth fund, the first question is, how did it do relative to the S&P 500 last year, last 3, last 5 years? How did it do to the growth indexes in the market? If it's not adding value above those two things, you should be open to changing it, particularly if you have a particular year where there's a loss and you might be able to realize a loss on the actual fund. I would say that the dividend growth strategy could easily be a replacement for a large cap growth portfolio. It could also be a complement if you already own the S&P 500 or have a broad portfolio of U.S. large cap stocks. The idea is it's a strategy that's designed to tilt towards higher quality and profitability. And there comes a point in the market cycle where people pay up to own the higher quality names, because a lot of the easy money in the bull market has already been made. And if you want a high quality portfolio, that's one way to get access to it. And there's ETFs from Wisdomtree that do so. There's other ETFs from other providers. But the ETF itself is an important step, because it means you'll get diversified across 200, 300, maybe 500 stocks. And you won't have to do the picking and choosing yourself. It's all done for you in a fund, an ETF that trades on an exchange that you can buy and sell during the day at typically much lower expense ratios than comparable mutual funds. So the point made earlier is a very important one. You end up keeping more of the dividend income that comes out of the fund, because the management company pays itself based on the dividend income that's collected. So if the management fee is much lower, you end up capturing much more of that dividend income as it flows through the fund. And that's one of the reasons people like to use dividend ETFs for their dividend exposures.
I think we might have a question over here.
Yeah, I have a question. I noticed that MLPs have really flattened out, yet some of them have outstanding earnings, and I specifically talk about the refiners. Like Northern Tier has a 16% dividend, just declared $1.08 for the quarter on a $25 stock. Calmet Partners, I could go on. I could name about 10. But they're not being honored for their great dividends, and they seem to have good earnings with good dividends. I'd appreciate comments.
Sure. MLPs, or Master Limited Partnerships, is an asset class that I use in the Westwood Income Opportunity Fund, and we also run a dedicated MLP strategy. You have basically three components, or three sectors. You referenced the refiners, which is referred to as the downstream. Then you have the upstream, which are the exploration and production, or the E&P. The vast majority of them are in what's called the midstream space, and those are the entities that own the hard assets. They literally own the pipelines, they own the storage tanks. I refer to them as the toll collectors of the energy space, and so they are paid a fee for the amount of either crude oil or natural gas that flows through their assets from there. But to your point, they're also pass-through entities. They take that income, it's not taxed at the corporate level, it's then passed on to the unit holders for MLPs. Now, I will say this, there are some opportunities in the refining space, but with that, I will say it is that, and also the upstream, it tends to come with a very, very high level of volatility. So that's not an area that I particularly focus on. The names that you mentioned, again, here's one of the things that I've learned, I guess, over the years, though, is that if a stock is yielding, as you say, maybe 16% or not, I can tell you what the market thinks. The market thinks that that's not sustainable. Okay, and so now there may be cases where it is and the company works out of it, but my experience has been that in most situations that dividend eventually ends up getting cut. So the question is, well, how do you evaluate that? In the MLP space, you want to look at what's called the coverage ratio. And it's basically the amount of funds that the MLP has available on a quarterly basis to distribute versus how much of that. And most of them want to run at roughly 1.1, maybe 1.2 times. But if you see a company that it's only generating roughly 80% of the amount of funds that it needs to fund that current distribution, I would be pretty cautious in that front, but on that particular situation. So that's one way I would look at it. The other thing, just very briefly, I'd mention in terms of the midstream, you're exactly right. Christine mentioned Magellan, which is MMP, but again, there's others. Plains All-American is another one. You have a 5.5% yield with roughly a 7% distribution growth. I think when you get into that kind of 12, 13, 14% kind of total return profile, there's a place for that in the portfolios in a broader standpoint.
Is there another question?
Yes, I'd like to ask a question. Christine mentioned 4 or 5 companies that she would recommend that we give consideration to for investing in dividend companies. I wonder if the two gentlemen could also identify 3 or 4 companies that they would recommend we give consideration to today.
Well, we don't do individual stock recommendations, but I would just say that we monitor all of them. And right now, of the 20 largest dividend payers in the U.S., 13 of them have raised their dividends since November, and 6 of them just raised it this quarter, which I think is important because they had an opportunity annually to raise dividends, and they did. And those 5 are Apple, Exxon raised, even though oil prices are down, Johnson & Johnson, Procter & Gamble, and Wells Fargo. So those are 5 of the largest 20 that just did an annual increase in their dividend, which is an important signal for the market that not a lot has changed at the corporate level in terms of dividend policy. So if you want to just look at those 5s as proxies for their industries, I mean, those are the largest ones in their sectors.
Yeah, just 2 others that I'd mention in addition to Becton Dickinson. from there. If you're looking in the industrial space, I think Honeywell is attractive. It was just was the cover story of Barron's this past week from there. But again, that's a company that's had at least over the last several years, been able to grow their dividend quite strongly. And also from an earnings outlook, we're very favorable on that. And then if you're looking for something in the financials, there, Capital One is another name that we feel will do well over the next several years.
I think we have like about 5 more minutes.
Yeah, the dividend growth. I have a couple of different accounts. Like I've got a Roth, I've got simple IRA, and then I've got a TD Ameritrade account where I have some dividend. Every time we get a dividend, it's a taxable event. I was wondering, how can I compound my growth of the dividends versus taking the income in my younger years? Can I put it in, say, a Roth IRA without having to have a drip fund attached to it where the dividends are taken as income? So where can I buy the dividends? Can I buy a dividend stock in the Roth where it can grow tax-free? Because the accounts that I currently have, the dividends are taken as income. It's a taxable event every time you make your dividend. So you're paying your income tax on those dividends as you receive them. Is there a way to buy the stock and put it in a growth account where you're not taking the dividends as income while they're growing?
You mentioned really an important issue, which is we call asset location, where you put which types of securities.
Right.
And generally speaking, if you have a choice and you've got something that's kicking off regular income, certainly any type of bond product, but also any security that's paying regular dividend income, you want to try to house it within some sort of account where you're not paying that tax as you go along. So Roth accounts you mentioned would be an ideal receptacle for anything with a dividend attached to it. Second choice would be a tax-deferred account, such as a traditional IRA or 401k. But definitely, if you have a choice, and a lot of people don't, in terms of which types of accounts they're holding, which types of assets, you want to keep the dividend payers out of your taxable accounts.
And I would just add to that if you can get a dividend fund that focuses on the qualified dividend payers that will qualify for the 20% dividend tax rate, that might be a better avenue to go than funds that start to morph into REITs and some other companies that are being taxed at higher income rates.
I suppose that's another feather in the cap for a dividend growth strategy, in that they typically would exclude those non-qualified dividends.
I think we have time for a couple more questions. Oh, over there.
I was just wondering, do you have any limit to the amount of yield that you would go after? I noticed that some yields are 10%, 15% REITs or so forth. Do you disqualify? I don't want to invest in a company that has a yield over an X percent. Is there anything that you may know on that?
I can only speak for what Wisdomtree does, but we have a screen where we're not going to include companies that have a payout ratio greater than 1. Another way of thinking about it is that the earnings they generate is greater than the dividends they pay out in that year. That's one way we deal with it. The other way is we actually weight the securities in the index based on the aggregate amount of dividends they pay. So even if a company had a high dividend yield, we're not weighting by dividend yield. We're weighting by the absolute dollar value of the dividend that's actually being paid. So that has a way of tilting the portfolio towards larger companies. And once you start looking at the larger companies, it's very rare to find companies with dividend yields, north of 4%. For the most part, they'll be between 2 and 4. And so that's dealt with indirectly through weighting.
Thank you.
I've recently read that there's a ETF which looks at 3 elements. One is the dividend yield, the second one is the dividend growth, and the third is the amount of the stock buyback for the companies. Do you know of such an ETF?
Someone in the audience knows the ticker. I don't. It's not a Wisdomtree ETF, so I won't comment on it. But I would just say, if you are interested in share buybacks, yeah, there are some ETFs out there that will incorporate share buybacks into this selection, and I think even into the weighting scheme.
Yeah. I think ultimately what they're trying to capture is not just dividend yield, but what's referred to as shareholder yield. And so that's what they're looking at.
I think we have time for one more question over here.
Gentlemen, I'd like to thank you for taking your time away from your more profitable pursuits at home, at the office, or at the computer screen. The speakers today talked about growth possibilities more in the emerging markets or outside the United States. And if we looked at large, medium, and small cap companies and then split them between the developed markets and the emerging markets, it sounds like to me, in my narrow thought, it's harder to have a dividend-paying company in an emerging market. But that seems like the sweet spot. I'm going to make a comment on that. Developed versus emerging markets, dividends.
Yeah, well, we actually calculated an index of emerging market dividend payers. There's roughly 1,200 of them across the globe. So there are plenty to choose from. And if you actually look at the MSCI Emerging Market Index, about 90% of the weight is actually in dividend-paying securities. So there are plenty of dividend payers in emerging markets. We actually have an emerging market small cap dividend index, which will give you just the small cap portion of the emerging market dividend payers. And it's interesting because emerging markets really haven't performed all that well in the last 5 years, and dividend growth in the emerging markets converted into dollars has not been all that great the last 5 years. But over the last 10 years, dividend growth from the emerging markets was actually faster than the dividend growth on the S&P 500, which was roughly about 7% over that period. So I think there is a case to be made to have some emerging market equity exposure. And certainly we have strategies that allow you to take advantage of the dividend-paying part of emerging markets. And over longer holding periods, our indexes have done fine relative to the broader market.
Do we have time?
I would just make a quick comment about narrowly focused strategies. And one thing I keep an eye on at Morningstar is we have a window into investor behavior through what funds they're buying and selling at various points in time. And one thing that we see is that the finer you slice things in terms of investments, the worse investor outcomes you tend to get. That investors tend to do better with broader product types. They tend to buy them and hold them. I think dividend growth stocks, some sort of dividend growth funds, in a large diversified dividend growth fund looks really good from this standpoint. The more refined you get in terms of what you're looking for, the less you're likely to stick with it through a variety of market environments. So just a word of caution on very narrowly focusing portions of your portfolio. Just make sure that you have the wherewithal to hang on.
I think we just have time for one more question. Sir?
Yes, thank you very much. Thank you for answering the questions. My question deals with individually investing in individual stocks. What are the maybe 2 or 3 indicators in case the market does turn south? What it is that we should be looking at when that's going to be coming for dividends?
I'm not really sure I heard the question. Did you?
Yeah, I think you're asking, look, what are some kind of maybe early indicators of perhaps stress in the market from there?
Yes.
Look, I would start with the fundamentals because I think that is the early warning signs, if you will. One we've kind of touched on here, but you put into what you see is decelerating earnings growth, or more specifically, negative earnings growth on a year-over-year basis. There have been times where that has occurred and we didn't have a significant correction, but there have been other times where that has happened beforehand. The other is actually looking at aggregate corporate profit margins. As you know, margins over the last several years as part of this bull market have moved up significantly. In fact, we're at record highs. But historically, on a cyclical basis, usually margins peak anywhere from 9 to 12 months before market peak. And so those are 2 very fundamental factors as opposed to perhaps non-fundamentals that I think that investors can look to. But look, I would also, the caveat would be is that, you know, I don't know of any perfect indicator. If there was one, we would all certainly be watching it.
Yeah. Thank you.
One last question.
Okay.
Is it advisable to buy NLP stock for IRA account
The question was, is it advisable to buy MLP shares for your taxable accounts?
Well,
I'm sorry, for your
IRA,
tax-advantaged IRA.
into account. Not to put everybody here asleep with talking about tax treatment, but you bring up a good point, a very important point, is that master limited partnerships, the distribution is actually treated as a return of capital as opposed to a dividend or income. And so you actually do not pay the tax on that. It actually lowers your cost basis, and so, but then you pay it when you sell it, so you have a capital gains component. So to that extent, if you're being charged or taxed on a capital gains component there, then having it in your non-taxable can work. Now, having said that, I also know investors who do use them in their non-taxable accounts from that, but because again the profile that they have. So, sure.
I think that's all the time we have. I really appreciate everyone coming out here. I just have one thank you. We have a nice round of applause for the panelists. One last administrative note. I just want to remind folks that in late September, Money Magazine, in partnership with the Money Show, is hosting its first cruise, and we're going to start. It's going to go from Montreal to New York. We're going to take in the fall foliage in places like Halifax, Bar Harbor, Quebec City, and eventually making our way to New York. It's really geared toward people who are looking at retirement strategies, specifically retirement investment, retirement income strategies. I'll be on board along with Money's longtime retirement columnist and expert Walter Updegrave. And we've got a couple of real heavy hitters in the personal finance world. Harold Avensky and Dina Katz will be joining us. And we'll have Jack Ablin, CIO of BMO Private Bank, and Marianne Stanek of Baird Advisors to talk about the markets and the interest rate environment. So we hope folks will give that consideration. There should be some brochures out back there. I want to thank everybody here for coming, and I want to thank our panelists again for taking time out of their busy work weeks to come to Las Vegas and play a little. Thank you.
Thank you.
Thank you very much.
Nice meeting you.